Hi everyone and welcome to this new video. This time we will be talking about how to get Canadian exposure. And as you know, we have a lot of index ETFs that tracks Canada, but which one to choose? In this video, we'll be discussing XIC, XIU, both from iShares and in comparison with BMO, the ZLB. At first glance, all these Canadian index ETF, they look similar. However, you have to keep in mind that they behave very differently. They have different objectives. So if you would like to invest in Canada and hold these ETFs, you have to understand what's beneath, what's the strategy, what to expect when you hold each one of them. One of the biggest mistakes investors make is assuming that Canadian equity ETFs are all the same. That's not true. Some ETFs tend to maximize market exposure, so they will go wide in terms of coverage. They will cover large cap, small cap, mid cap. Obviously, some investors would love that. They'd love to have total market exposure, not just specific. Other Canadian index ETF will prioritize liquidity, so they will try to hold stocks that exhibit high liquidity or specific ratios. Others focused on risk reduction. So an ETF, the principal objective would be to reduce volatility. So if you don't understand these differences, you can end up with unnecessary volatility. Let's say you buy an index ETF uh, and you're not really a long term, or you're not ready for those up and downs that the markets tends to have. And you would have, if you knew, you would have bought something low volatility index ETF and not a normal index ETF. You have also duplicate exposure. A lot of people hold, for example, XIU, XIC, and ZLB in the same portfolio. So I would explain why you shouldn't do that, and if you do it, how to do it. So this video is about making intentional choices. So when you buy an ETF, you understand what it is exactly, and not just chasing returns. The XIC, which is issued by iShares, one of the largest fund issuers in the world, XIC tracks the S&P TSX capped in composite index, which represents almost the entire Canadian equity market. This includes large cap, mid cap, small cap, with sector exposure across banks, energy, materials, industrials, tech. Think of it of this is an ETF. So what does it mean is that instead of you going out there and just picking the winners of the day or the winners of the week based on something you see on your mobile phone in Wealthsimple or any other brokerage firm, instead of that and taking that risk of buying a specific stock, you would hold an index ETF. An index ETF is basically by buying just one ETF, which trades like a stock. So you could go in, you just enter XIC, and you will see it will pop up S&P TSX caps composite index. You would just, if you buy just one share of that, it's like you're holding a basket of stocks, because this is the role of ETFs, is to simplify our life. And if we want a diversified portfolio and a specific market like the Canadian markets, with a diversified portfolio, this ETF will answer our needs, because we would invest directly in over, for example, in the case of XIC, in over 200 plus Canadian companies. XIC does this also with a lower MER, management expense ratio, of 0.06%. This is really nothing. It's like when you invest $1,000, the fund itself, the manager of the fund, will only take away 60 cents out of $1,000. So it means that it's really low. And this is the biggest advantage of holding an index ETF. If you don't have an index ETF in your portfolio, you should, because it's one of the best way to reduce risk and have the market return. As you know, like studies have shown, whether like in the 70s, 60s, 80s, 90s, 2000s, managers of active portfolios, this is people who spend their life studying finance, managing portfolios, they have hard time beating the return of the market. So it's one of the best way to stay ahead of the crowd and have the market index return at a very low risk, because you're super diversified. So the MER is a big plus here for XIC. There is also strong long-term growth with broad diversification. We will have a look later on at the performance, and you could see that it has been a great performance. And usually index ETFs in the long term, they end up really being a great hold for investors. It's an ideal core holding for long-term investors. So even if you are into stock picking, you still need an index ETF there just to keep as a buffer, and it moves much less than just holding some specific stocks. So the 10 years annualized return is 11.68%. So this is a great return over a 10-year period. So on an annual basis, the average return is 11.68%. On a 5-year, the number was 17.58% annualized return. This is absolutely great. And in 1 year, it's 28.68%. It distributes dividends because when they invest in a basket of stocks, if these stocks pay dividend, then they just give you back the dividend, and the dividend yield is 2.38%, 2.3%, and it's coming from Canadian companies, so it's ideal. There is no tax deduction there or anything. It has a large assets under management, which means that it's highly liquid. So if you buy XIC, you could sell it very easily. The spread is really narrow, and it has 19 billion assets under management. So it's one of the most popular index ETFs. Top sectors, obviously, this is an image of Canada. So the financials and energy and materials will be overrepresented a little bit. It's best for buy and hold in a TFSA or an RRSP. It works really fine there. The second one, XIU. XIU tracks the TSX S&P TSX 60. The 60 there means that you're really investing in the 60 largest companies in Canada. So you have there just large cap. So in comparison with XIC, which has large cap, mid cap, small cap, here you're really focused on large cap. Why would you want to do that? A lot of people prefer large cap because that's where most of the growth comes from. Also, the portfolio will tend to be a little bit more stable since it holds only large cap, which don't move as much as small cap or mid cap. So you have there major banks, energy giants, telecom, large industrials. XIU is extremely popular, a very liquid and widely traded, making it popular with institution and active investors. The only drawback here is the management expense ratio, which is 0.18%. So it's not really super high, but in comparison to XIC, it's a little bit more expensive. But it wouldn't make a huge difference, say, long term. So XIU holds far fewer stocks, just 60 in comparison to XIC. It's more concentrated. It tends to move during market cycles, obviously. Large cap, they also react to market cycles. Historically, XIU and XIC deliver similar long-term returns, but XIU experiences sometimes larger swings because it's less diversified, especially during drawdowns. In other words, XIU is simplicity and liquidity. XIC is diversification and balance. Now to the third one that, if you're not familiar with, will be really interesting for you, especially if you're anticipating a market correction or market drawdown. ZLB takes a completely different approach. Instead of holding the entire market, it selects Canadian stocks with lower historical volatility. That usually means fewer energy names, fewer cyclical stocks, more defensive. Because when you are looking for volatility, the first measure of volatility is beta. And beta measures your sensitivity to the market overall movement. So if you invest only into low volatility stocks, low beta stock, you end up with something that's very stable. And that's usually companies like Metro, Loblaws. So these type of defensive sectors that they're not really impacted that much by a recession because their business model is super stable. They don't exhibit high growth. They're not growth stocks. They are mostly stable, large companies. So ZLB is not trying to beat the market. It's trying to smooth the ride. So picking only stocks in very stable industries like utilities, staples, healthcare, and it has an MER, a management expense ratio of 0.39. The more you get to an active kind of, or there's a selection, the MER goes up. But all these index ETF, they're still in a low end in terms of MER. And they're all excellent, like in terms of MER, they're still very, very good choices. So with this ZLB, you're getting only, it's a low volatility strategy. So if you're anticipating market drawdowns and you want to buy stocks that are very stable, that can endure market corrections, and you're not sure which stocks to buy, you could just invest in ZLB because you will be there in a safe area with utilities and staples and healthcare. And as I mentioned, staples, for example, Metro, those type of companies, they don't get impacted by the hype in the market or the drawdowns. They don't get impacted that much because their business is stable. There, you still need to do your groceries, whether it's a recession or a growth. So that's why the utilities, the same thing, you still to have to pay your electricity bill, your gas bill. So healthcare, the same thing, you still have to go to the doctor. So that's why ZLB invests in those sectors, because that's the sectors that has companies with low volatility. So the 10-year return average yield, annual average yield is 10.56%, which is absolutely great because you're looking, it's very close to XIC. And it has, in my opinion, a better adjusted return because for lower volatility, you almost end up with the same long-term performance as XIC or XIU. So this is 10.56% 10-year average. For a 5-year, it's lower than XIC and XIU. It's at 14.86%. The 1-year return is 18.95%. This is as of October 31st, 2025. It has a dividend yield of 2% and assets under management of 5 billion, which means it's also highly liquid. Head-to-head comparison, let's compare them directly. So XIC holds the most stocks at 214. So it's super diversified, and it's diversified not just in the number of stocks, but also in the type. So it's small, mid. So it has all type of stocks there. The MER, it beats XIC, beats XIU and ZLB. Volatility, XIC and XIU will have similar volatility because at the end of the day, they are index ETFs that are tracking the Canadian market. So they will have the same, almost the same volatility. ZLB will be definitely lower because it tracks only stable businesses with low beta. The role, XIC would be like a core position because you're holding a picture of the market. XIU will be a large cap core position. So if you want to invest in Canada, but you want to focus on large cap, XIU is the great choice there. And ZLB will be added there to defend your portfolio in case you're expecting a correction. Now in portfolio construction, this is where most investors go wrong. Holding XIC and XIU together does not increase diversification. You're just overlapping. It simply increases exposure to the same large Canadian companies because XIC still, like it has mid and small cap, but large cap, they weight heavy in XIC too. So if you buy XIU and XIC, you end up with the same exposure to those large cap. Choose either one, depending on your choice, whether you want just large cap or you want a little bit more diversification, go with XIC. If you want lower MER, go with XIC too. This is a smarter approach. Don't try to have them both in your portfolio. So choose one core ETF, either XIC or XIU. Then optionally, if you would like to have ZLB because you want to reduce volatility, then you can also invest in ZLB. Keep in mind that ZLB, those utilities and all that, they're also present in XIC and XIU, but at a lesser, obviously they have lesser weight in XIC and XIU. So ZLB, I would imagine you would have that if you want to stabilize your portfolio, you're expecting a correction down the road. So you're adding a little bit of ZLB, replacing XIC or XIU with ZLB. And if the market's uncertainty goes away and we have a growth period coming up, then you go back to those growth index ETFs. Or if you are conservative, you could just hold ZLB and stay with ZLB. So which one should you choose? Let's simply, like if you want to just summarize it quickly, XIC is best all-around core ETF for most investors. XIU best if you want to maximize liquidity because it's definitely the trader's favorite. XIU, and also you want to have a large cap focus. ZLB is best if you want downside protection and smoother returns. So there is no universally best ETF. It depends really on you, on your choice, your risk tolerance. The right choice depends on your risk tolerance, time horizon, and your behavior during market stress. So that's very, very important to keep in mind. So all these ETFs are definitely great tools to diversify your portfolio. The key is not which one performs the best in a single year, but which one will help you stay invested in the long term. I hope this video was able to clarify any questions that you had. Please, if you like the content, please don't forget to like the video, share it with your friends, and also subscribe. Thank you very much for listening. Have a great day.